Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello and welcome to the Stock Play of the Day. My name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. All right, well, it is Tuesday. Happens to be a special Tuesday. It is Election Day Tuesday, so make sure you get out there and vote today. And because of that, we are going to actually look at the SPYs as far as the stock play of the day. We're going to look at just almost a fear of missing out trade. A lot of people, including in our weekly viewpoint that we put out last week, are talking about the fact that after the midterm elections, the markets have always had strong markets going all the way back to 1950. Now, with that said, I think the thing that scares me the most about everybody talking about it is that everybody is talking about it. So a contrarian would come on out and say, because so many people are believing it to be true, that it's a sign that it just may not happen, because it's usually better when you figure those things out on your own instead of all the pundits on all of the financial shows all saying the exact same thing. Just kind of like on the contrarian aspect of it. We like to see the VIX skyrocket up above 45, 50% and get that shaking out in the marketplace, and then everybody turns bearish on the market, and that's when you kind of get the shaking out of all the sellers. And a lot of times, if you want to be contrarian on the other side, and that's when you want to get bullish. So the only thing that really scares me about it, and I haven't mentioned it much, is that so many people are talking about it. So how would I approach this trade? And we'll look at we're going to use the SPY, just because why not, right? The SPX is up and running. The Russell 2000 index has been doing fairly well. The NASDAQ has obviously been a laggard. A lot of the tech stocks, even after their earnings last week, did not do as well. We do still have a lot of retail earnings that are coming in November, and that should be very interesting to see if the consumer is still staying strong. We have a big number on Thursday. CPI is coming out. It might actually overshadow the elections and what's going on today. So I think that I'm a little bit more nervous about that CPI number not showing that we have peaked as far as inflation is concerned. That's probably my biggest concern of the week. And it doesn't necessarily need to be down. It just needs to be going down a lot. It just needs to be going in the right direction, not increasing. And we did have some rolling over of fuel prices, gasoline, some other materials, commodities is the word I was looking for. Some other commodities that have kind of led their way into saying that the CPI could be lower. One of the biggest one is housing prices. We kind of had housing prices roll over. A lot of the housing stocks that have already announced are basically forecasting slower sales. lower housing prices going forward. And that takes a little bit of time before that shows up in the CPI number. Hopefully, this has been a little bit of time. Everybody keeps saying that we've peaked in the inflation market, and the CPI number just does not show it. Okay, so fear of missing out. If everybody is right about the 1950 midterm point of view that the markets have done so well, it's been, I think somebody I heard quote that it's been 22 midterms since 1950, and the market has been up, let's say 6 months later after those 22 midterms, and usually finishes up for the end of the year. Well, I shouldn't say usually, I guess it has finished up according to what everybody is chatting about. Okay, so we did a fear of missing out trade last week, just trying to find some places that we could get bullish on the market. We did quite a few bearish trades going into September and October, but now the seasonality to go along with the midterms is saying this is usually when the markets like the calendar the most. So now we're going to try to find ways to get long the market, and one of the stocks that came out and had fairly good earnings actually said that they could not meet the demand, and mainly because of some supply constraints, was Caterpillar. So last week we looked at a fear of missing out trade in Caterpillar, and I do always want to emphasize that none of these trades are meant to be recommendations. We're just trying to learn here on the stock play of the day. What the stock play of the day is all about is, inside my book, the Options Playbook, we have over 40 different strategies, and we try to apply those strategies to the current market conditions. And on a fear of missing out trade, I don't want to risk a lot of capital, but I still want to be in the market. So we bought an out-of-the-money call in Caterpillar, and Caterpillar did pretty well over the last 4 or 5 days. So let's, first of all, take a quick peek at that chart in Caterpillar. 1 second.
Stock play of the day.
And we'll go back 5 days in time. So we see going back, well, and we can even go back a little bit further. When we always do the stock play of the day on Tuesday. So since Tuesday, the market has actually gone up quite a bit. The low of the market was 212.50. We currently see the market today trading at 231.67. So very strong move. Around 17% since we talked about it on Tuesday. So obviously our trade should have worked out just fine. So I'm going to run over to the Ally Invest charts, and we'll look at the trade real quickly here. So in this expiration date, we have the June expiration. We looked at buying the 200 strike call in June. We see it at 231 right now. So if we go down to the 200 strike call, when we looked at doing the trade, we saw the trade was at 35.50. That's approximately where the midpoint was. Right now, if you had the trade on, we went out till June just to try to give it some time, try to give the rest of the year to play out. We had the midterm elections. We talked about a lot of the other things that could be bullish. Now, the stock has made a big move very quickly. So there are a couple of things that I would think about doing. First of all, think about selling it. We paid $35.50. We're up $10 on that trade, well over 30% on the trade. We were only buying one contract. That's always what we just look at, is the smallest lot. So $3,550 is what we had in it. We could sell it for $4,680 if we hit well, that's the ask right now. So let's call it 46. That's fine. Would work it at 46. And all we would do is take this order that we were long this option contract to try to sell this trade now. So we're just going to go in, instead of selling to open, we're going to be selling to close the position, put it in at a limit price of 46, let that order work for the day, see if we could get out of the trade. Straightforward. We had a real strong move. before we get maybe a little bit of a bounce back, because stocks don't have a tendency to just continue to go straight up. We're in an option contract. We're not in the stock. We had the strong move. I would be much more apt to sell my fear of missing out of the money option contract, which is now fairly substantially in the money, as opposed to going out and selling a stock outright. I might consider staying in the stock a little bit more, but I have a time component that's in that option contract. So when I get to move, I want to get out, especially if it matches my forecast for what I had in the underlying. Now, with that said, you may consider selling some option contracts against it. If you still wanted to stay bullish on Caterpillar after a strong move like this, I'm going to close this trade, and we could either sell a June 16th expiration contract. If you just want to put it on, set it and forget it, come back in June and see where we're at, see if we did increase more or not. We'll take a lot of that money off the table and we just let that trade ride. So if we were going to do that, we want to keep in mind that we paid $35 for that underlying. We're at $24. We have 220 days remaining till that expiration date. So I still want to give myself quite a bit of upside. So if I'm going to take some of that money off the table, I might sell the 270 or the 280. I'm going to sell something that's going to bring in a lot of premium. And basically, I'm going to roll into what's called a long call spread, which we're going to be doing today. So the trade would then eventually, instead of having unlimited upside, we would have limited and known upside. We still have our strike here down at strike A, which is going to be the 200 strike. Our strike B would be 280. That means we'd have 80 points total that the trade could trade, or that the strategy could trade for. But with that said, I'm going to put on, if I put on this trade, I'm going to take off some of the risk by doing it. And so if I do it, I do want to get something for it. I'm not just going to sell a $1 or $2 way out of the money option contract. If I had this big run up, I'm going to sell an option contract that has some premium because I want to reduce my risk overall on that trade. So how would that look? If we wanted to adjust the trade, which once again, not meant to be a recommendation, I'm just giving you some ideas. I would have this option contract long in my account. So I'm going to look at the call side of the option chain. I'm going to go back and make that a buy, implying that we're long that option contract. And then we'll go up, I guess we'll sell the 280. Give ourselves a little bit more upside. We would sell that 280 strike and we would bring in $9.20, hence reducing our risk by $9.20 or $920 if we could fill somewhere near that midpoint. And then we'd just put this trade on. And if I did this, you know, if the market did come down and it started trading somewhere near my cost basis, I would consider getting out of the trade. But besides that, I'm just going to kind of let this one run. My outlook would be for that upside. It's a real long time until that expiration date. That's how I would approach this trade if I was going to do the same expiration and leg into that long call spread. Now, one other alternative is to just say, well, in the short term, I'm nervous because we've had such a big run up in the short term. Why don't I go out and maybe just sell a 17-day option contract? So I noticed I switched my chains. I went over to the expiration dates here at Ally Invest. I looked at 17 days, which is the November 25th expiration. All right. And now I won't be able to go up as high and I won't be able to bring in as much capital for the account, but we're trading right around, well, where we're at, 31.71, pretty close to 32. I can get a decent dollar amount. Well, even the 250 strike isn't too shabby. I mean, I can get almost $1 on the 250. Maybe I do the 245, but I only have 17 days to expiration. If I'm selling this option contract, I'm hoping that it expires worthless. I don't own the stock. I own an option, something that's acting a lot like the stock. So I really don't want it to expire, or I don't want to be assigned on it, because then I'm going to have to deal with the fact that I have an option contract with a lot of time premium in it, and I'm going to have to deliver stock at some way, shape, or form. Now, ideally, if that did happen, I would go out on the marketplace and buy the stock and deliver that stock. I would not exercise my option contract. And that's a complete seminar by itself. So if you're going down that road, I'd just say do a little bit more research on it. But if I do this near-term option, if it does get to the 245 strike, which is, I guess, the one that we'll say that we would sell, and I'll just put a little sell thing here, okay, just so you know that this is the one that we're looking at. And if it did happen, I would be looking to roll the option contract. So once it got to 245, I wouldn't mess around at all. I would roll up and out in strike. I have a lot of time in my near-term option contract, so I would continue to manage that position. And this would be a much more hands-on approach to this option strategy if I did a shorter-term option contract. All right. Well, if you have any questions on this, very rarely do I have a lot of trades when you have a stock that just had a really, we're long a call and the stock went up. I mean, that's a real good scenario. And if that happens, very rarely do we look to go on out and just adjust that trade. We'd usually just sell it and move on. But I always want to give you a little diversity here on the stock play of the day. Bottom line is you have some questions. What I just went through was fairly quick. Please put them in the chat box. We want to make this a more interactive platform. So if you can, ask these questions. Ask these questions about the Caterpillar trade. And now I'm going to actually move on to this week's stock play of the day, and feel free to talk about the SPYs if you would like. All right, so I'm going to start by looking at my dashboard. I'm going to look at my VIX watch list. So I have the VIX watch list up, and we see the VIX is trading right around 24%. And I do expect volatility to wane a little bit going into the end of the year, especially if we have a bullish market. I did like to see that the VIX actually in September and October, they finally got up above that 30 level, which made much more sense to me, considering what's going on in the marketplace and globally. But now we've had a fairly strong market. We're getting into a different time of the year. The VIX is still fairly high, around the 25%. I think normal volatility nowadays is right around 20%. If we were going to look at like a 200-day moving average, the VIX right around 200% would be normal volatility. Below that, I would consider it low. Above that, I would consider it high. Now, going all the way back before the pandemic, I wouldn't have said that is the case at all. I'd say the VIX down around 15, 16%. It would be the normal. But there's a new normal now in the VIX. 20% implied volatility is now the old 15% implied volatility. But we also have the election, and the marketplace does not like unknowns. So after that filters out, I do expect the VIX to actually go down a little bit more. CPI number is going to be a big number. I don't expect it to wane too much until we get that number, and we'll see what happens when that happens. Okay. NASDAQ is up 1.5%, SPX is up 1%, and the IWM or the Russell 2000 is trailing a little bit, a little less than 1% today. All right, so let's get into the SPY. Okay. We look at the SPX, which is basically the SPY is the ETF that tracks the SPX. I see a couple of good things on the chart, and I'm going to highlight, I do believe in charting that here and now can be a little bit more helpful than going years and years back, especially when we're talking about moving averages. We haven't had our ducks in a row in quite some time where we have the 20-day, that's moving average there, below the 50-day, below the 200-day. When we had that, we had a fairly strong market, but then it turned around right away. Now, one of the things that people will talk about in moving averages is what's called a death cross. Don't put a ton of weight when it's the 20-day over the 50 days, but you had the 20-day cross below the 50-day, and that kind of hinted at a bearish market. Then we had the 20-day finally bounce back, and we had a strong market. Guess what? We're kind of right back in that situation. It crossed over, weak market. We're coming back to the point where we could get what would be called a golden cross, where the 20-day crosses over the 50-day moving average. Now, that's just one little simple indicator, nothing too major you want to look at other different indicators in the marketplace, but I would put a little bit more weight on it if it was the 50-day crossing over and above the 200-day. I think that would be that's usually a bigger sign. And we had that here where the 20-day tried to cross over the 200, couldn't quite get there. The 50 never really came back, and this rally kind of stalled. So in this instance, it's always good to have your ducks in a row, to have the 200-day, then the 50-day, and then the 20-day. That's a sign of a very strong bullish market. So this would be the start if we could get that. Okay. Now, I'm going to go and look at a long call spread. And part of the reason, last week we looked at Caterpillar and we just bought an out of the money option contract based off of just earnings reports and getting a little bit more bullish going into the end of the year. So a stock that you could kind of get your hands around was Caterpillar. So we went out of the money and just bought a straight out of the money call. My trepidation here is everything that I just mentioned at the top of the show is that everybody is talking about the fact that the markets have done so well after midterms. So that makes me a little bit more nervous about it. So I'm not quite as bullish on the SPY in this strategy that I'm going to use as I was in Caterpillar. We're going to go out longer term, but I'm going to do a long call spread. I'm going to sell something against that position to generate some income to help pay for my long call. Don't have as much upside on it, and it's going to take longer for the trade to play out. So as opposed to just buying a long call and maybe adjusting by selling a call against that position and legging into the long call spread, we're going to start out by doing the spread. And that just means that, and this is what stock play of the day is all about. This means I'm not quite as bullish on the SPY as we were last week on Caterpillar. So that's simple. All right, so let's go and look at the Ally Invest option chain. So let me find them here. And in the well, that's Caterpillar. 1 second. I think this one is going to be the SPY. Okay, so SPX, nope. There's the SPY. All right, up 1.1%, so it's down a little bit from the top of the show. We have the market at 384.16, so that is a more expensive underlying, so the option contracts would be more expensive, and I say more expensive relative to Caterpillar. And we're going to go all the way out. We're going to go out not quite as far in time. We're going to go to the December 5th expiration, which has 27 days remaining. Market's at 380, let's call it 385. So quick math, if I'm just looking at what the expected move would be, which we usually talk about around earnings, but if I just look at this, I want to use this information to try to pick the strike that I'd be willing to sell. So the marketplace, if I just add 9 plus 9 together, that's 18. Do the change, we're about 19 on the expected move. If that's the case, we'll just round up to 20. All that is giving me is what the long straddle is for the most at-the-money option contracts. And it gives me some hint as to what the marketplace thinks a potential move could be in the SPY. Now, it doesn't have any regard to direction. It's never bullish or bearish. It's just saying it's like an over-under as to what, based off of the volatility of those option contracts, how much the marketplace thinks the underlying could move going into that expiration on December 5th. Okay, so 20 points. So the math is simple here. 85, 95, 405 would be approximately 20 points. That option contract is still trading for a good dollar amount. So it's still a fear of missing out trade. So I'm going to start by buying an out of the money option contract. I'm going to give myself a good bit of upside. 405 would be at the high range of the expected move. I think I'm going to keep the math simple here. We're going to go 10 points, but we're going to buy the 390, nice round number, and we're going to sell the 400. So it's well within the expected move, giving me some upside. Say I've had some capital on the sideline and I'm a little nervous. I mean, a lot of people have gotten out on the marketplace, and any neighbors, friends, relatives that have told me that they've gotten out because the market has been bearish. Um, my question to them is, when are you going to get back in? Are you going to get back in when the market comes back 5%? Are you going to get back in when the market comes back 10%? Like, where do you feel like you should get back in? And let's say it's down 10% from here. Would you buy then? Would you get back in then? Or is the market going to be too bearish? If you're getting out of the marketplace and you're messing with your retirement funds, you have to answer those questions before you get out of those positions. If you want to ride the wave and do the dollar cost averaging in your 401k, well, that's what we talk about. If you have the time to try to let the markets come back, well, that's usually a solid plan, and that is a plan. That means you are doing something. That means you have thought of it. You're dollar cost averaging into the market. You're buying more shares of the market, if you will, when the market's down with the same amount of monies as opposed to when the market's up. So this trade would be a fear of missing out. You've gone out, you've already exited your position, you have some cash. Well, maybe I'll put this on as a hedge, not spend as much capital as just being in the market. But what if everybody that's been talking about the midterm elections actually plays out? What if that does happen? I would like to at least have some capital allocated to the marketplace, and this is one way to do it. Once again, not meant to be a recommendation, just throwing ideas in and showing you the flexibility of the options marketplace as a whole. Okay, so I'm going to scroll down here. Our trade, the max that it could trade for is $10. We can pay $4, $3.59. All right, I'll put that in the right rail. Well, real tight markets in the SPY. I would, you can't ever guarantee a midpoint fill, but I'd feel fairly comfortable about it here. Even if you paid the ask, it's not that big of a deal. There's only a few penny cent wide spread. We'll call it 360. That means for every 1-by-1 spread that we're doing, your total risk will be $360 plus commissions on that trade. And our maximum upside then would be 10 minus 360 or $4.40 worth of upside. The only downside here about doing the long call spread to start with is that if the markets are positive and it starts going up, the short option contract doesn't want that, right? The short option contract wants the market to stay the same or go lower. And so you kind of battle with each other. So the maximum of this trade, which we called as $4.40, you wouldn't expect to get that until closer to that expiration date. Part of the reason why I chose a December option contract, where in Caterpillar, we just went out further in time, because in Caterpillar, time was our friend, right? We were going to get long, we were long Caterpillar on our out of the money call option going all the way out till June. And that allowed us to just sell it and get out of it because we had the strong move. But if you are long a call and short a call, you have to be more accurate on when the move would happen, because you need some of the time premium to come out of that short option contract. So we're going to sell the 400. That would be SPX 4000. We're going to buy the 390. We're going to put this position on, and we're going to hope that we get that rally that everybody's been talking about after the midterm elections. All right. So if you have any questions, please feel free to put them in that chat box, and I will try to address them right now. All right. I'm going to give you a few minutes because last week I went in and I called it a little bit sooner rather than later, and we had a couple of questions that popped in at the last second. So if you have a question, let me know right now in that chat box. And if not, then I guess we'll just put it off and we'll see what happens in the elections. Today, we should have a lot of news by the end of the week. And see you this coming up Tuesday for the next stock play of the day. Please smash a thumbs up if you're liking this, please share it with all your friends and family. This is a free event for all. You don't have to be an Ally Invest client to partake in the stock play of the day. Ring the bell or click the bell and ring the bell. I don't know how I'm saying that. All right. So with all that being said, please let people know about the stock play of the day, and we'll see you this coming up Tuesday for the next stock play of the day. Thanks for coming, everyone.